Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 20th of August. I'm Daniel Lam, your host for the podcast. I've gotten some skepticism about the podcast yesterday, where we outlined a bullish case for Chinese equities, especially in the technology sector. And as is often the case, that skepticism came from remarks about the Chinese economy. Now, it is true that the broad-based weakening in real activity data was seen in the month of July, especially in domestic demand. Industrial production, fixed asset investment, and retail sales growth, they slowed quite a bit, coming in weaker than market expectations. Meanwhile, trade growth accelerated in the month of July, beating expectations, partly because of export front-loading from the US. Now, the investment drag spread beyond the housing sector. Property investment contracted deeper by 17% year over year, and the fixed asset investment in both manufacturing and infrastructure recorded a year-over-year decline for the first time since 2021. But I would like to highlight that the weather may have disrupted construction. Consumer goods retail sales contracted month on month for a second straight month. That suggests softer household demand. The boost from the consumer goods trading program likely diminished after June's online shopping promotions. Meanwhile, services retail sales growth stayed solid at 5.2% year over year. So, taking all these together, yes, the weaker data should sound some caution to China's policymakers, but we do not believe they are likely to be moving policies abruptly. We see that the government may prioritize implementation of the current budget, including accelerating infrastructure investment, facilitating purchases of unsold homes and undeveloped land, and expanding the trading program to services, while preparing some contingency plan to prevent any further economic weaknesses. Moreover, stocks move by expectations, and it is true that compared to the doom and gloom that investors were feeling about Chinese equities, say about 5 months back due to Trump 2.0 and the tariff, the current situation is not as bad as feared. Hence, we believe that, especially in the selected areas such as technology, the Chinese companies can do well from the AI wave and their relatively cheap valuation versus global equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.